Hello everyone again, and welcome to this particular video. And in here we're going to be exploring the nature of borrowing money, and in here we're going to see how this actually influences how worthy or credit worthy you are as you go approach borrowing money from either someone that you know or from an institution. So in this particular video we're going to look at borrow work, which is the nature of borrowing money, and our goal is to be able to investigate personal loans and also pay borrowed money from the bank, and also options available for repaying borrowed money, and finally establishing and maintaining a credit rating. So what is the keywords that we are going to explore in this video? So we're going to explore keywords like cosigner and how that's going to be influential in simple and monthly payments, and also dealing with loans, how this actually requires sometimes consolidate in terms of how that is going to trickle down to other forms of loans. And finally here we're going to look at credit rating and how this actually influences your debt. So in here we're going to start off with how these keywords is actually planned out in your mind or in terms of a flowchart. So speaking of loans, we know that loans is a money that is actually lent to you as a borrower from a lender, and the lenders can either be from a bank or someone that you actually know, or from a specific borrowing institution or a lender institution. And this money is actually given to the borrower in order for the borrower to do some specific stuff. And before this money is given to a borrower, there are various requirements that the borrower must actually meet. One is that the borrower must actually have a co-signer, someone that is there to actually sign off that specific loan and is actually a witness to that particular event. And once this is actually done, usually it's done from a bank, and this is done before the bank actually borrows the money to you as the borrower. So you need someone, either a family member or a friend that you really know and trust, that is actually the co-signer. And you will also have to actually check your credit rating. So the lender will actually check your credit rating, and if your credit rating is somewhat good enough, then it means that they actually trust you to actually pay back that loan over X amount of time. So the credit rating goes from around 300 to sometimes 900, and you have to meet that particular good criteria in order for that particular credit worthiness to be valid for you, and so that you will be able to actually be financially responsible for the money that you loan from that specific bank. Take note that this credit rating takes into account any bills or payments or credit card that you've made, and hopefully you haven't missed any of those payments. And once you haven't missed any payment, that will actually contribute to a good rating. So since you have this taken care of here for credit rating, take note that the higher your credit rating, this actually leads to the more loans that you'll be given to from a specific lender. So that is a good thing to take care of or keep in mind. And next question you want to ask yourself is, why do people take loans? Mainly the reason why people take loans is because of this concept called consolidate. And consolidate, what does it mean? This means that you take one big loan to pay a number of small loans. Like for example, here we have this green money here that is the Consolidate Debt, and this can be used to pay off any credit cards or any form of payday loans or student loans or utility bills or tax debt. And all this needs to be done in order for you to reduce that particular interest rate that compiles from each of those smaller loans that could contribute over time to a much more bigger money that you might owe. So hopefully that your consolidate loan that you collect has a small interest rate, so that won't actually influence how much more money you owe over time. So this is one thing to keep in mind in here. And then what are the interests that influences the loans? Because various lenders, they make a lot of the money from the interest that is added to the borrowed amount or the money that they lend out to you. So one interest form is called simple interest, and this is actually determined by multiplying the principal by the rate and the time, and that gives you the interest. And once you add the interest to the principal, which is the money you borrowed, that is how much you actually pay back to the lender. And the other one is the ones that lenders do lean towards, which is monthly interest. And how you calculate the payment on borrowed money only depends on three criteria. One is that they actually follow a compound interest investment rather than simple interest. And how does this actually look like on a graph? If you have your dollar on the y-axis versus the length of that period that you actually let that money to actually grow in terms of the lender's perspective, this actually shows a relationship where a compound interest actually grows faster in money compared to that of simple interest, as you see on the red versus that of the orange line respectively. So in conclusion, compound interest is way more beneficial than simple interest for that specific lender. However, this actually means that you will have to pay more to that particular lender through compound interest than that of simple interest, as you see in here, versus that of compound and simple interest. We see that the money you pay through compound interest is way more than that of simple interest at that same year or time that you actually decide to pay that specific money back. So in conclusion here, this means here that the lender will earn more than you. As we see here, we see that if you borrow that particular amount of money at the beginning of time, over time you end up paying more to the lender, either one or the other, and the lender will benefit more at the end. So you have to keep this in mind, and this is actually crucial, because while the lender makes more, you actually at the end of the time will have to pay more. So how will you be able to actually avoid being in this situation where debt actually comes in? Sometimes debt actually applies to you when you forget to actually pay back that particular money at that particular time to the lender, and that could lead to some financial trouble, like decreasing your credit rating. And once you decrease your credit rating, that could impact how many loans or how much more loans you might get. Therefore, you will be getting less loans if you require to borrow more money from a specific lender or from an institution. So I rather advise you actually pay every single money at the required time, and don't miss any deadline in terms of payments of your money, and this will be beneficial for you. However, if you are actually consistent in paying the lender those money that you owe, this actually requires three things to follow. Please make sure you make lump sum of payments so that you will avoid all those interests that could accumulate over time. Therefore, you pay more interest if you pay over a long period of time. So you want to pay lump sum of payments, or you can change the frequency of payments. So instead of you paying once every month, you can pay twice every month, and you can pay in lump sums instead of little sums or so. And finally here, you want to take on a bigger payment. Taking on bigger payments means that in here you want to make payments that has higher interest, so that over time you will be able to actually avoid all those interest that compound on bigger money that you borrow. So it's a good thing to keep that in mind. And this is all that you need to know about loans and how that influences your credit rating and also influences your debt. So in here, we're going to look at various questions that involves loans and debt and how to make payments. And all this comes from terms that you need to keep in mind in terms of money and borrowing. So column B, you will use those keywords to actually answer questions A under that particular column. So question 1 says that when one borrows money, therefore you are taking out a what? It means you're taking out a loan, and that loan has to be paid back, and you have to take that into consideration. The answer for number 2 in this case here is interest, because once you borrow the money, the bank actually charges interest, which the bank makes a lot of money from. So it means that the more interest you pay, the more money the bank gets. So the bank will try to increase the time required for you to pay the money, thereby adding interest on each payment you make, and that actually makes the bank to make more money. So you want to keep that in mind. And for question 3, it says that you might get a weak what if you forget to make a dash or 2. This means here pretty much that you have to deal with your credit rating, and dealing with credit rating means that the weaker your credit rating, the more you miss out on payments. So the relationship between credit rating and payments actually makes a huge role in how financially stable you are, not now but in the future. And next and final question is, if you have to dash your money or your loans when you have borrowed money from the loan service and have a higher credit balance. So this here means that you may have to consolidate your loans when you have borrowed money from the loan service and have a high credit card balance. So you want to be able to consolidate in order for you to actually pay off any specific high credit balance that you might actually have. So that is it for this type of question. Another question that could come up is, where are the places that you might like to borrow money from? There are big places like banks or credit cards, and there's some other non-financial or risky places like family and friends. And well, one of the risky ones I would say as well is money loans places, and all these all contribute to where you actually borrow money. And the big question here is, which one is better and why? I feel personally that the ones that has the least interest actually is way more beneficial, and the ones that either has zero compounding interest or something that has more of simple interest applied to is actually beneficial, and you want to pay that particular money at a shorter period of time to avoid those interests included, for you to have a better and beneficial place to actually borrow money from. So those are the factors that leads to which area you want to better borrow money from now or in the future. And this actually leads to the next question that some people might ask in here. And in this question, you're asked to complete a specific table that involves investigating the amount borrowed, which we see from A to D is the same, and the number of payments as well is actually the same in the next column. And the third column here shows you the interest to be increasing from 2% to 8%, and we have to fill out the blanks, which involves the monthly payment for B and C, and we have to fill out the total amount replaced for A, C, and D, and finally we have to determine the total interest paid for A, B, and D. So let's assign various acronyms for each of these columns. Like for example, amount borrowed will be presented as the PV, which is the present value, and the next column here, number of payments, will be represented as N, and I, which is interest, will be represented as R, and the interest in here, we're going to convert it pretty much to the decimal value of that percentage. So 2% is 0.02, 4% is 0.04, 6% is 0.06, and 8% is 0.08. And then next is a monthly payment acronym. Here we're going to deal with it as MP, and the next one here is the total amount, and the total amount repaid actually comes from the monthly payments. And in here, the monthly payments, to determine that, is the amount which is actually divided by the number of payments. So the amount repaid divided by the number of payments gives us the monthly payment, and the total amount paid, which is represented as A, to determine that, is multiplying your monthly payments by the number of payments. So in here, this leads to the total interest paid, which is represented as I, and I actually is determined by subtracting the present value from the total amount that is on the fourth column right there. So let's solve this particular, or fill in the blanks. And in here, for the first one, we have to find the total amount repaid, which means we're multiplying our 12 by the $425, and that gives us $5,100. And the interest paid, you subtract the we subtract the present value, which is 5,000, from the amount, which is 5,100, and that gives us in here $100. And the next question here is to determine the monthly payment for question B, and what we see is that we're given the total amount, which means if we divide that by the number of payments, which is 12, we get the number, which is $433.33. And once we have that number, it means here that we're going to use the present value and subtract from the amount in order for we to get the interest, which in this case is 5,200 minus 5,000, and that gives us $200 for the interest in B. And the next one here is C. We have to determine, I would say first, the amount, because we're given the interest, and the interest, which we know, is 300, and we know the present value, which is in this case 5,000. It means that the amount, you add those two numbers together and you will get $5,300 for the total amount that is repaid by the borrower. And to determine the monthly payments, you just divide your amount by the number of payments, which is 5,300 divided by 12, and that gives you your monthly payments, which in this case is $441.67. And finally, for D in here, since we're giving the monthly payment, this is similar to the A question, and in here what we have to do is determine the amount, which in this case you multiply the monthly payment by the number of payments, which in this case is going to be given as $5,400. And to determine the interest, we subtract the present value, which is 5,000, from the amount, which is 5,400, and that gives us $400. So what we see is that the interest rate, which is shown in percentage, increases as the interest paid increases. So this actually shows us that from this next question, which is what does the table above tell you about interest rates when you apply for a loan, this actually shows us that the higher the interest rate, which is what we see in the third column, we notice that in this case, as R increases, the more interest you pay back, which is shown by the final column right there, where we see we're going from $100 to $400, which shows that there is an increase in the interest that you, the borrower, pay back. So you have to keep aware of that. So you want to go for lower interest instead of going for higher interest lenders principal that they give out to you. So it's always good to go around, check out different lenders and see what they have to offer. Always choose the lower interest rate so that you'll be able to not only pay the money quicker, but also not lose that much money due to the interest that they add to your principal over X amount of times. So that is it in here for question 2. And the next question here is looking at a specific person, and this person not only actually has a place where the person borrows the money, which in this case is $5,000 from a specific institution or so for a bank loan for the person to start a pet grooming business, but also this person actually has a credit card to finance the business as well. So we're going to look at the first one in here, which involves the bank loan, and in here the person borrows $5,000 for 3 years at 10%. So in terms of the solution here, the question says that how much interest will the person be paid? Now in this question, we know that this is not compounded, so that is what you need to take note of. So if it's not compounded, so we're just going to deal with the simple interest and just determine the interest after 3 years. And to do the simple interest, we're just going to highlight the principal, which is 5,000, and we highlight the time, which is for 3 years, and we highlight the rate, which is in this case 10%. You change that to decimal, which is 0.1, and then once you write down your givens, we actually write down our required, which is to determine the interest. We know that we'll have to use the formula, which is the interest is equal to the principal multiplied by the rate and the time. So in this case, once we multiply all those numbers, which is 5,000 for principal times the rate, which is 0.1 times the time, which is 3, we actually get our interest to be $1,500, which is a huge sum of money you have to add to the principal to pay back to the lenders, which is the bank loan. So the next question here is that how much is the total that will be paid back as loan as the borrower? So this is a big money, which means here that to find the total loan paid, you have to add the interest, which is what we determined in here, A, and add it to the principal, which is the money that was borrowed by IBOJ. So as a result here, we add our interest, which is 1,500, to the principal, which is 5,000, and as a result of that, what we get is $6,500, which is such a huge sum of money right here. And it's just because of the interest. So you want to go for lower interest. 10% is too much. You want to go for something less next time in the future. So IBJ here, monthly payments in here is you have to pretty much divide the total loan paid by how many months in 3 years. So we know here that for the monthly payment, we know that the monthly payment is equal to the total loan paid divided by the total month for the 3 years. So to determine the total month for the 3 years, we know that we're going to multiply 12 because we have 12 months in a year. So in 3 years, you're going to multiply 12 by 3, which gives us 36 months, which means you're going to be paying that paying the money, not 6,000. You're going to be paying 36 times to reach $6,500. So in here to divide your $6,500 by 36, you'll be able to find how much money you'll be paying to the bank loan every month for 36 months. So in here you're going to be paying $180.56 every month for 63 months, for you to settle the bank loan, and you don't want to miss any payments, otherwise that could influence your credit rating, not now but in the future, which could decrease your credit rating and therefore put you at a financial risk for any potential loan that you might want to take from a specific bank or institution. So the next question here involves the credit card that IBJ actually uses, and there is a credit card statement that he received on February 8th, where in here we're asked to fill in the blanks for the overdue payment, which we see right here, and the new balance, which is at the other side. So let's focus first with the overdue payment. And the overdue payment in here, to determine that, we pretty much have to subtract the payment from the previous balance, as we see at the above sections right here. So we have the previous payment, we're going to do that minus the payment that IBG made at a specific period of time, which is around the 10th of January. And once we do that, it means that our solution here is $379 minus $300, and that gives us $79. And once we put that down there, the next one is to determine the new balance, which is actually determined by adding the overdue balance to the interest charged, which is $14.02, and finally is the new purchase, which is, or purchases, which is around $1,461.83. And once you do that solution, we will be able to determine the new balance that IBJ actually owes the credit card company. And in here, once you add that number, we see that how much IBJ owes the company is around $1,554.85, and that is what matters in here. The new balance matters because that's how much you owe the credit card company. And take note that the annual interest rate is around 18.9%, so you want to keep that in mind going in here. So in here, the approximate total money that IBJ owes, not only from the credit card but from the total loan that IBJ borrowed from the bank, which is $5,000 initially, but now the interest that is applied to that money, which is now putting the money at $6,500. Actually, if you add that to the credit card money new balance, which is actually around $1,554.85, that actually gives us the total money owned by IBJ, which in this case is around how much? In this case, gonna be a big money right here coming in soon. $8,054.85. That is massive. And then going in here to choices that you have to make for IBJ, and if you are a financial institution, and what options should you give IBJ financial situation. In this particular case, overall, you want to conclude definitely that IBJ spending is really weak and poor. The person doesn't know how to manage money in here, and in here, since his spending is so poor, and this actually shows, is actually shown pretty much by the credit card statement and how much the person actually borrowed from the bank in order for him to actually start off this particular pet company. You want to wonder how will he be able to actually pay off that particular loan that the person only borrowed, but also how to not miss any credit card payments that could potentially lead to interest added. And if that money increases and IBJ is not able to pay back this money, that could be detrimental for IBJ's financial situation through decreasing his credit rating and therefore putting him at a financial risk. So what advice would you give IBJ in here? So the big advice here is to pay off the credit card first due to the high interest rate. So since the credit card has such a high interest rate, which is 18.9%, so much money compared to just 10% from the bank loan, you want to pay the credit card frequently first, so that the credit card company will actually feel confident in you that you are actually meeting those payments, and they'll have that trust that you are financially responsible, and they will be able to be comfortable giving you more money in the future. So you want to keep that in mind, but then be able to be paying that small money that you're paying monthly to the bank loan, which is around $180 approximately, so that you'll be able to actually put yourself at less risk of financial trouble. So that's about it for this particular video. The reminder here is assignment 9 to use this video and notes to complete the assignment. This is the final assignment. This is due on June 11th of this particular year. So the assignment is actually found on your Power Space and through the emails. And speaking of emails, please don't forget to email me if you have any questions. By that way, I'll talk to you through there or through Google Meet, so by that way we can discuss more on some of the solutions to the problems. So that's about it for this particular video. Thanks for following me through this. Truly appreciate it. Hit a comment down below, let me hear your thoughts. By that way I can talk to you all soon. Stay smart and believe in yourselves.